Herding bias, also known as herd mentality, is a common behavior in trading and investment. It describes the tendency of individuals to follow the actions of a larger group. This behavior often occurs without independent analysis or verification. Traders and investors may mimic the decisions of others, regardless of their own research. This can lead to uniform buying or selling patterns within the market. Herding bias can amplify market trends and potentially create bubbles or crashes. Herding bias occurs when traders mimic the actions of others without independent analysis. This behavior involves copying trades or investment strategies. Traders may not fully understand the reasons behind these actions. Herding is driven by the perception that following the crowd is a safe strategy. Herding bias is significantly affected by emotional factors. Emotions like fear can drive individuals to follow the crowd. Greed can also amplify herding behavior, as people chase perceived opportunities. These emotional responses often overshadow rational analysis. Consequently, decisions made under herding bias may lack logical judgment. Herding bias causes individuals to align their behaviors with a group. This alignment can lead to the suppression of independent judgment. Individuals may overlook information conflicting with the group's consensus. Contradictory data is often ignored to maintain conformity. This selective attention reinforces the herding behavior. Herding bias is a cognitive bias, where individuals mimic the actions of a larger group. This bias often causes investors to concentrate on short-term market trends. The focus shifts towards immediate financial gains. Consequently, long-term investment strategies are frequently overlooked. Sustainable investment approaches are also neglected due to this short-sightedness. Herding behavior in trading and investment is influenced by social factors. A key driver is the desire to conform to the actions of peers. This conformity stems from the fear of being excluded or missing out. Investors may mimic others' decisions to feel part of a group. This can lead to irrational market trends driven by social pressure. Following the crowd can lead to a diminished sense of personal risk. Individuals often assume the group possesses collective wisdom. This perceived wisdom is believed to mitigate potential losses or dangers. The presence of others creates a sense of shared responsibility. This diffusion of responsibility lowers individual feelings of vulnerability. Herding behavior occurs when individuals mimic the actions of a larger group. This behavior often arises from the belief that others have better information. People may assume that the actions of others reflect superior knowledge or insight. Consequently, individuals may choose to blindly follow the actions of the group. This can lead to information cascades, where decisions are based on others' actions rather than personal knowledge. The reliance on group behavior can override individual assessment and critical thinking. The concept of safety in numbers offers psychological comfort. This comfort stems from a reduction in anxiety. It also alleviates uncertainty related to making decisions independently. The presence of others provides a sense of security and shared responsibility. Market bubbles and crashes are significant events in financial history. These events often demonstrate the impact of widespread herding behavior among investors. Herding behavior refers to investors following the crowd, often without independent analysis. The dot-com bubble serves as a notable example of a market bubble driven by herding. Subsequent crashes highlight the potential negative consequences of such speculative bubbles. These cycles underscore the importance of rational investment strategies and risk management. Meme stock frenzies highlight the impact of social media on market behavior. These events demonstrate how collective action, fueled by online platforms, can drive stock prices. The GameStop saga exemplifies this phenomenon, showcasing rapid, social media-driven herding. Such frenzies can lead to market movements that deviate significantly from traditional financial analysis. This herding behavior often results in irrational pricing and increased market volatility. Understanding these dynamics is crucial for investors navigating the modern stock market. Market crashes can lead to panic selling among investors. Panic selling involves investors rapidly exiting their market positions. This rush to sell often happens simultaneously across many investors. Herding behavior during panic selling intensifies market losses. Herding bias is a psychological phenomenon where individuals mimic the actions of a larger group. In asset purchasing, this bias manifests as buying assets after significant price increases. This behavior is often driven by the fear of missing out, FOMO, on potential gains. Such decisions may not be based on individual analysis but rather on perceived market trends. Herding bias is a psychological phenomenon affecting financial markets. It causes investors to mimic the actions of a larger group, often irrationally. This bias leads to buying assets when prices are high, driven by market enthusiasm. Conversely, it prompts selling during market declines, fueled by fear and panic. The result is frequently suboptimal financial outcomes for individual traders. Buying high and selling low erodes potential profits and increases losses. Herding behavior in markets involves investors mimicking the actions of a larger group. This imitation can lead to amplified market movements, both upward and downward. Increased volatility is a direct consequence of herding, as prices fluctuate more dramatically. These fluctuations make it difficult to predict future price movements accurately. Ultimately, herding behavior contributes to a less stable and more unpredictable market environment. Portfolio concentration occurs when a disproportionate amount of investment is allocated to a limited number of assets. Overexposure to popular assets, often fueled by herding behavior, can cause this concentration. Herding refers to investors mimicking the actions of others, potentially inflating the value of certain assets. This concentration elevates risk, as the portfolio's performance becomes heavily dependent on the success of those few assets. Herding bias leads investors to follow popular trends, potentially overlooking less-known assets. This behavior can cause investors to ignore undervalued investment opportunities. Unpopular assets may be dismissed, despite their potential for future growth. By conforming to the herd, investors may miss out on significant returns. Independent analysis is crucial to identifying opportunities overlooked by the majority. A trading plan provides a structured approach to market activities. It introduces discipline into the trading process. Adhering to a trading plan helps to reduce the impact of herding bias. Herding bias is the tendency to follow the actions of a larger group. A trading plan encourages independent decision-making. It promotes rational choices based on personal analysis and strategy. Independent research is vital for informed investment decisions. Data analysis should be the primary driver, not market sentiment. Relying on market sentiment can lead to herding behavior. Herding involves mimicking the investment actions of others. This can result in irrational investment decisions and increase risk. Independent analysis helps avoid these pitfalls, promoting more stable investment strategies. Contrarian investing involves deliberately opposing prevailing market sentiment. It focuses on identifying and capitalizing on unpopular or undervalued investment opportunities. This approach seeks to avoid the risks associated with herd behavior in financial markets. Herding can lead to inflated asset prices and subsequent market corrections. By going against the crowd, contrarian investors aim to buy low and sell high. Success requires independent thinking and a willingness to challenge conventional wisdom. Risk management strategies are implemented to mitigate potential losses. Stop-loss orders are a key tool in limiting downside risk. Position sizing helps control the amount of capital exposed in any single trade. These strategies reduce emotional decision-making during market fluctuations. By limiting emotional exits, herding behavior is also minimized. Regularly reviewing trades is crucial for identifying herd-driven patterns. Herd-driven patterns can indicate biased decision-making in the market. Self-reflection on decision-making processes promotes awareness of potential biases. Increased awareness helps traders recognize and mitigate their own biases. Mitigating bias leads to more rational and potentially profitable trading decisions. Focusing on long-term fundamentals is crucial for rational investing. Short-term market fluctuations should not dictate investment decisions. A long-term perspective helps avoid impulsive reactions to market noise. This approach reduces the risk of following market trends without proper analysis. Maintaining a rational strategy protects against herding behavior in the market. Excessive exposure to news and social media can stimulate impulsive decision-making. This stimulation can lead to herding behavior, where individuals follow the actions of a larger group. Limiting news and social media consumption can mitigate these effects. Reduced exposure provides individuals with more time to think independently. This independent thought process can help prevent impulsive reactions driven by widespread trends. Herding behavior has roots in evolutionary biology. Following the group historically increased survival rates. This instinct is a deeply ingrained survival mechanism. In modern financial markets, herding often leads to suboptimal decisions. Blindly following market trends can result in poor financial outcomes.